Hi, this is Chapter 9, Introduction to Income-Producing Properties, Leases, and Market for Space. In this chapter, we're mainly focusing on basically the first thing listed on these chapter objectives and the last thing. We will talk about, mainly first understanding the major property types, and then lastly, the importance of leases and all of the different aspects of how you'd price a lease. Now, we'll also talk about the economic forces that are affecting the value, including supply and demand, location analysis, and competitive nature of real estate. But this is almost an entire separate section. We do be doing market analysis and such, and I'll speak to this, but it won't be our major subject at this point because it would require a lot of actual research to go out and make this more meaningful. Some of you that are doing graduate work may decide to pick this up and do this as a project. Okay, but our main focus right now is because we want to be able to price real estate, especially commercial real estate. We're looking at income producing, but specifically focusing on commercial, is that we understand the property type, and then to price we need to understand the leases. The market research as to the economic effects was also very important, and we'll touch upon it here, but that portion of it we won't have enough time to do much actual work in that area. Okay, the major classifications of real estate are residential and non-residential first, or we may have a mixed use, which has both residential and non-residential. So you may have a condo complex that has retail stores in the bottom and a restaurant and so forth, a couple of offices. But mostly we'll be focusing on residential or non-residential. In the residential, we talk about single-family home. Now here we'd be talking about a single individual detached house versus multifamily. A multifamily is broad. It could go from such as a duplex or a three-family structure to high-rise apartments to garden-style apartments. Okay, but an apartment type situation would be the multifamily. The non-residential, which will be our major focus, commercial, so office and retail. Okay, that's mainly where we'll focus. There's also the area of hotel motels, industrial, warehouse and showrooms, recreation, so sports complex, country clubs and so forth, institutional use, government agencies, hospitals, universities. Okay, and as we mentioned, it could possibly be a mixed use. Again, many different areas of classifications, and we could study them all, and they take many times. So our main focus will be office and retail. Specifically, again, office would be the major focus. We'll look at retail also. We'll touch a little bit on apartment complexes, so the multifamily apartments. Others we might touch upon, but won't spend a lot of analysis time on. Okay. The next few slides I'm going to skip through fairly quickly. Again, mainly because we don't have the time to do the actual research itself, but we'll just touch upon the major factors and the major findings. Although this is something that we won't be able to spend specific time on, and most of them are fairly obvious to you. So as far as the major supply factors for housing factors of demand, again, similar to what we talked about in the residential area, new housing formations, okay, age composition of those new households. So if you've got a whole bunch of new formations, but they're 55 and older, or they're brand new couples, so forth, household income, employment would be important there, and the mortgage credit conditions. Okay, so what are the mortgage rates, and are there a lot of bankruptcies or not? The supply factors would include production. Okay, are there a lot of building production available or not? Productivity and number of builders in the market. And again, credit conditions is important on both sides because it's important to the builder side also. Some retail demand And supply factors, demand, number of consumers, consumer income, right? Consumer tastes and preferences, prices of substitute products, and credit concerns. Again, it's going to be always a factor. But especially, versus, again, you can see what they say, number of customers, customer income, and so forth. Obviously, these would have effect on, are we in expansion or recession? Economic factors. Factors of supply, price, and productivity, of the factors of production, number of developers, okay, we put developer expectation, and again, credit conditions. Okay, so many economic factors that we'd study. Office, okay, demand, number of local firms, okay, are there local firms moving in or out? The types of businesses, okay, do they have a large profit margin? Do they have a lot of money that they possibly could go and pay more market rent or not? The growth in the local firms, office space per employee. Okay, so the more office space per employee, more office space they're going to need. Factors of supply, those are very similar to the market, the retail markets. You can look at those. Some of the things they found, summarizing from looking at past, that firms competing for space will result in the highest possible rents for the most profitable locations. Okay, so we will find that, once we find the competition, that's where the highest rents will go. Not surprising. Locations will tend to be determined by clusters of users with similar financial structures that relate in similar ways to a given location. Okay, so they need to be in the financial district, okay, in downtown Boston. So you'll have them cluster, which Getty Financial District, as they have similar financial structures and they relate, they're going in the same business, and in that area you'll have banks and brokerage firms and so forth that are relating to each other. We find that locations with the greatest appeal to users will provide higher rents and also higher densities. So if they have a large appeal, you'll find that people are drawn to that area, so they'll have higher density of use, higher rentals. Firms that are cost sensitive for competition are competitive for locations, so with large amounts of land and large facilities. So they are very cost sensitive, but they are large facilities, so they're very competitive in that area. Some summary of factors on the tenants. Load decision factors for the households. Okay, one of the things, again, business is going to decide on is they're going to seek to avoid transportation costs. Okay, so they're going to have incentive to locate close to their economic centers. So if they have to make a lot of deliveries, if that's what their business is, they're going to try to be close to where they make the deliveries. They need a high amount of employees. Okay, this business takes hire a certain type of employees. They're going to want to be located where their employees can get to them easily, and so forth. So if that's not important at all, that they be near anything and delivery isn't important, then they might want to be further away from the city, out away from everyone, where they therefore wouldn't be asking for higher rent. They could save on the rent and just have their space far away from everyone. So it depends on what they need. They don't want to be out in the middle of nowhere if there's no employees and they need multiple employees. Okay, so they've got to decide what's important. Price of the land decreases with the distance from economic activity centers. So again, they have to decide, do they need to be closer? Do they need to be right there, right next to the airport and the bus terminal and the employees? Okay, it's going to cost them more as far as the rent, but maybe we'll save them more in transportation and employee fees. Okay, and I mentioned these. Transportation costs. Is it important? All of these are some of these. Important to be close to your customers. Okay, so financial district, right? That they need to be right there in the midst of everyone. So they need to be close to their suppliers, so the suppliers can get them their goods because they're manufacturers. Is workforce proximity the closest, the most important factor? How much area do they need? Do they need more big, large areas of land? Then they really can't be in the city, so forth. the type of service? Is there a high density or low density demand? Is there multiple, increased density with the people that have to be there, or the low density demand? So a business has to make a decision on real estate. So they may decide, okay, we've factored in where we need to be. Okay, do we need to be in downtown in a city, or could we be out in the suburbs? How much space and so forth. So they figure out where's their best location. And then after that, the other thing they need to figure out is, should they buy it or should they lease it? Okay, we find overwhelmingly that most people rent. So most tenants find leasing. Obviously, the tenants, so they find leasing, but most businesses find that leasing is more cost effective than owning. And so, for example, you're a small business trying to get started, and you want to be in multiple malls across the Northeast. Well, it wouldn't make sense. You're a small business. You need a small piece of space in multiple malls, but you don't need to own the entire multiple. You don't need to own 20 malls in the Northeast. Okay? What you need to do is have a presence in each of them, so it's much more cost effective for you to just rent in them than purchase all these malls. Okay, why? Well, one main thing is owning requires large capital commitment. Imagine how much of capital commitment it would be to purchase one mall, no matter multiple malls. Okay. Owning reduces the operating flexibility. Okay, so it's once you own, it's harder to reduce space or increase space or change your location. Okay, because you own the mall. Okay, well, now you've just got that set amount unless you have to reduce it. Well, that means you have to rent out more space. To increase it, you would have to add on to the mall. If you want to change the location, you'd have to sell and go elsewhere. Or if you want to just have more locations in different malls, if you're trying to own, then you have to buy all these different malls again. Once you own, you have to maintain. Okay, most companies, again, just like we'll talk about with the companies, don't even really want to focus on their accounting or their finance or business plans. They want to focus on the main core of their business. They also don't want to focus on owning and maintaining the real estate. They just want to do their business. They want to, if they're a retail store selling jewelry, they just want to focus on selling jewelry, making, selling, choosing, all the aspects focusing around jewelry, not focusing on real estate and rental and heat and energy services and custodians and so forth. That's not where the company wants to focus its energies, and everyone has a certain amount of time and energies and employees they can devote, and so they'd rather focus on their main core business. So one of the other things that's emerged is a large economic market for real estate services. Okay, so property management is a big field, okay, since, as we mentioned, most businesses tend to lease rather than own, and then you've got a bunch of people leasing, so these properties need to be taken care of. And if they do choose to own, they again still, even if they're owning, don't want to be in the business of real estate, so they'd rather hire someone else to basically maintain and take care of that business. So property managers that would oversee the property, make sure it's maintained, take care of the financing, take care of the research into market rent so they could advise someone. So say they do decide, well, we're major tenants in this mall, so we will, or major tenants in this office complex, so we will buy the office complex. But we don't really still want to be in the business of real estate. So they hire a property management team, and those people, part of their job would be able to do market research and say, this is the demand of the market. Just as a real estate broker, when you're selling your own personal house, this is the demand of the market. This is what you can expect to get on your house to sell it, or this is what you can expect to rent your house for. These people would be expected to know the market, do the research, and say, this is what you could expect to get when you rent out your retail area or your office space or your apartment complex. This would be the rent you'd expect. You should count on 10% of it being vacant and so forth. You should assume that when you have a new tenant, you have to put so much into fixing up the space, or the market, it's so competitive right now, you can expect to be 100% leased up, and the tenants will fix up their own space. They're just so happy to be there, whatever it may be. That would be, again, a property manager's job, and that's what a company would hire someone for. Okay. So, to summarize the asset market, the real estate values would vary according to their physical characteristics. Okay, their locations. Okay, so they're a very desirable, newer, updated office building in right downtown of a large economic center, and we are in a large expansion, versus rather an older, not well kept office building in the suburbs, 30 miles from the economic centers, and we are going into a recession. So obviously those are going to have huge factors on the value of the real estate. But what we find specifically when we're valuing commercial real estate is that the real estate values depend on the income expectations. Okay, so what income? Especially we're going to focus, you'll see in the next few chapters, we're going to start talking about leases now. So we're developing the rent end of it. And we're going to end up in the next couple of chapters, so getting down to the cash flow and valuing these properties. And we'll see that it depends on the income specifically that we're going to get from these properties, and then the relative riskiness of that income. So here's our income, but we are entering into a recession, and we've got multiple tenants with leases that are turning over in the near future. Okay, versus a great marketplace where we have 2 or 3 tenants that are in great financial condition and have long-term leases locked in with us that are at or above market rate. Okay, so we have to talk about the different cash flows and then the relative riskiness. Is it a stable company that's in there with a long-term lease, or a not so stable company who's having financial troubles, multiple tenants with financial troubles? So we have to talk about the riskiness of the cash flows. Okay, let's get into the specifics of the lease, which is, again, our second area of major concern in this chapter. One is just getting down to property types mainly, just reviewing, as we did quickly, some of the factors that affect real estate. And then lastly, and most importantly in this chapter, understanding the lease. Okay, because if we understand the lease when we leave this chapter, we'll have a much easier time developing the cash flows in future chapters, which we'll be using those cash flows to value the property. Okay, so this we've already really learned. The lease assigns the rights, duties, and responsibility between the lessor, which is the owner, and the lessee, the tenant. Okay, so all of the rights, duties, responsibilities are assigned here in the lease. And the risk, this is key, the risk is shared between the two through the varying lease terms. So you can think of this as the same kind of relationship as the bank with the borrower. And how do they share the risk in that aspect? As we just finished studying a lot, they share that risk by who's going to take the interest rate risk and the default rate risk. And we talked about, we can give some of the interest rate risk through adjustable mortgages, and we can give more by how often we make the adjustments, by how the adjustments are made, what index they're to, and so forth. And then we can also, as we give more and more of the interest rate risk, we find that the bank would start to take on some more of the default risk. Okay, we're going to see similar tendencies here with the lease. We can give more and more of the risk of expenses and inflation and so forth to the tenant. Okay, but then of course as we do that, we would have more possibilities of the tenant defaulting and not staying and running away off on their list. So very similar relationships. The features of the characteristics we're going to see in these leases. And again, our major focus here on leases will be office and retail. Specifically office to start, and then we'll bring in the retail. So the date, the term of the lease. Is it a year lease, a 3-year lease? Is it a monthly lease? Who's the lessee? Who's the lessor? legal description of the property. The allowed uses. Okay, so what can you use this for? Can you use this for office, for sales, and so forth? Restrictions and alterations. Okay, what can you do to the property? Can you bring in machinery and actually produce things here, or is this just strictly an office or a retail facility? Who's going to maintain it? Okay, and who's going to make the repairs if something happens? All of this would be laid out into the lease. Are there any restrictions on the operations of the tenant's businesses? So sometimes there'll be things that it's a large anchor, and so a large anchor of Best Buy, they don't want Circuit City moving in. Okay, something like that. So that could be part of it, or specific operations that aren't allowed. No, you cannot manufacture products here. You can only sell your products. Can you assign or sublet the property? Okay, so then you say, I don't really need all this space, but my lease is a 5-year space, a 5-year lease, so can I end up subletting it? In other words, someone leasing from me for part of that time. The use of the common areas. Okay, so you may have a large lobby where you come into in your office complex. What are the availabilities of that? You may have a top floor with a view. What are the uses, availabilities of that? Adequate insurance, okay, terms of default. And then as far as money factors, the base rent. Okay, so what's the per square rent that we'd start off? Are there any increases built in? Are there what we'll call steps? Does it increase $1 a square foot every year? Or is it increased by whatever CPI was last year? So how does it increase if it does? Same as we talk about with an adjustable rate mortgage. Does it increase? How often? What index? What's the margin? Similar aspects of a lease. Okay, we start off with a certain, instead of an initial rate, we start off with initial dollars per square foot. And then we say, does it increase or not? How often? What's it based off of? Gross lease versus net lease. Who pays the expenses? Tenant improvement allowance. Okay, so when someone moves in, they want to say, I want the office space right now has each person getting 100 square feet per employee, whatever it may be. I needed to have 120, so we need to change the walls. We need to move the cubicles for the office and so forth. We need to have a conference room. You don't have a conference room. Can we take 2 of these offices and combine them into one conference room, so forth? So these would be tenant's allowance. Would the owner of the real estate change the property aspects of the real estate? So take 2 offices, make it into a conference room. Would they pay for that or not? Rent concessions. Okay, if it's a weak market, they talk about, okay, we'll move in, but we want 2 months free rent, so forth. Or we want, as we can see right now in a weak market in the real estate, residential, as we've been talking about, where builders may be saying, we'll offer a buy down, offer you preferential financing. Well, again, in the rental market, they say we'll offer you half rent for the first year or free rent for the first 6 months. And then what are the lease renewal options? Okay, so you've got a 1-year lease, but you have the option to renew or not. You have the first right of refusal and so forth. Okay, so this slide summarizes what I've already mentioned here. Think of the initial rate as the initial interest rate on adjustable mortgage, and then the initial rate depends on the other terms. Okay, so if you're giving more risk to the tenant, if you're the owner giving more risk to the tenant, then you're going to have to offer a lower rent, lower effective rent. We'll see how to calculate that. If you're maintaining and keeping some of the risk, then you can offer a higher rent. So same kind of thing. If you have a fixed rate, then you can demand for a mortgage, you can demand the highest initial rent, interest rate. But if you have an adjustable mortgage that adjusts monthly based off a 3-month treasury with a 2% margin, and it allows negative amortization, so you're given almost all the interest rate risk back to the borrower, then in that case you must offer the lower end of the yields. Okay, same aspects with the lease. If you're giving more and more of the risk to the tenant, then you must offer them, to be competitive, lower market rents. Okay, so we need to understand, especially for the future chapters, all the risk aspects. Okay, just as we talked about with the adjustable rate mortgage, how often does it renew and adjust, and what is the index, and what's the margin, and so forth. Same type of things with the rent. What's the base rent? What's the initial term? How does it change? Is it a step-up provision? So we just say it goes up 1% a year. Okay, it goes up $1 per square foot a year, so forth. So it's a set amount, kind of like a graduated mortgage payment. Or is it just off something like a CPI index or a treasury rate? Okay, so now we're building in some actual inflation expectations. And with shopping malls and retail, one of the things you'll see is it possibly a percentage of the rate based off their sales? Okay, so now are we taking into account the economic qualities, vitality, economic success of the actual tenant themselves? Another way to share risk is who takes responsibilities for the expenses. In a gross lease, okay, if all the operating expenses are paid by the lessor, thus the owner bears the risk of any unexpected changes in interest rates. So if you're paying just straight gross lease, no other aspects, then basically all the expense risk is being kept by the owner. In a net lease, when the lessee pays all operating expenses, so except for there's a management fee, then that's already going to be paid. Then the lessee is assuming all the expense rate risk. We could talk about triple net lease. Here, the lessee not only pays for all the operating expenses, but also property taxes, insurance, and maintenance of the property. So they'd also be taking on the risk of the operating expenses, the property taxes, the insurance, and the maintenance. Okay. Expense stops. Okay, these are important. These require the lessor pay the operating expenses up to a specific dollar amount, and then usually level of expenses which they were started at, and then after that point the tenant would pay. So you might start off at rent of $10, say, per square foot, and the current expenses are $4 a square foot. So at that point, the owner is paying the $4 a square foot, and say that's what the expense stop would be. So at that point, if the expenses go up the next year, the owner pays the first $4, and say it goes up to $5, then the tenant would have to pay the extra dollar. And that continues all the way through whatever the term of the lease is. Say it's an office lease for the 3 to 5 years. And so $4 is always kept by the owner. Everything above that would go to the tenant. If for any reason expenses went down, then the owner would get the benefit, because the most they'd ever pay is the $4. If it went down to $3, then they'd only have to pay the $3. So when you think of that with this expense stop, the owner has given away all the risk of possible increases of operating expense, but kept if they go down. Okay, so think about that like an aspect of mortgages, that you give away if anything goes up, right? In expense, in interest rates, for example, with a mortgage, well, that the person that's borrowing has to take. So in this case, say the tenant has to take any increases in expenses. But if it goes down, then tenant doesn't benefit, only the owner benefits. Okay, so if the interest rates went down in a fixed rate, for example, only the owner benefits. Now, in this case, we say that you could renegotiate. You could walk on it, but on your lease, just take off and walk on the lease. But again, there's the aspect of being sued for that. So same thing is, can you, it's not as easy as it would be with a mortgage, say, to just say, well, if there's no prepayment penalty, there's no cost, then I'm just going to refinance. Okay, it's not so easy with a lease. You have a certain time commitment, and if you just leave the lease, the owner could sue you for the remaining amount of the money. Expense pass-through, the portion of the increased pass-through to the tenant may be capped. So, again, we might have an expense that has a stop at $5, but so after $5, the tenant would have to start kicking in anything above that, but it would never go above $9. Okay, so if you start off at $5 and the next year it's $6, so the tenant has to pay $1, then next year it's $7, so forth, up to $9. So the most they'd ever have to pay is the $4. Let's say the next year it goes up to $10. Well, then the owner would have to pay the first $5, and then the last ones, the owner would have to pay the $6. The tenant would still be capped out at that $4. Okay, so some of the expense risk is then given to from the owner to the leasee, but they're also maintaining some of it, because if it gets too high, the expense risk goes back to the owner. An example of expenses. The tenant has an expense stop of $5 per square foot based on the expenses of the first year lease. Expenses per square foot are currently $7, and the tenant has 15,000 square feet of leasable area. How much does the owner and the tenant pay? So the owner pays $5 times the square footage, 15,000, and the tenant pays the difference, because you had the stop at $5, but the actual expenses were $7, so they paid the $7 minus the $5, the stop, $2 times the number of square feet. So in this case, it would work out $2 times 15,000 square feet, or $30,000. It's important that you understand this aspect, because that's how we're going to use these terms in the lease to develop the cash flow that we'd expect from a going property, and then from that cash flow value the property. And other, again, aspects we mentioned previously, but listed now, concessions, so free rent periods that might be built in, tenant improvements. Okay, so rather than, it's kind of like a buy down, rather than actually lowering the rent, they'll say, well, instead of lowering the rent, what about we give you allowances to fix up how you want your particular property site to look like, and we'll fix it up for X amount, $10,000, whatever it may be, tenant improvements. You could have equity participation. Again, specifically a lot of this is built in where you offer the key tenant an equity interest in the building, so that would give them more attraction to come to you. Again, other options would be the lease renewal option, allows them to renew it at the end of the term. Right of first refusal, mentioned briefly before, so that they may have the right to release the same space before it's offered to others. It may also be offered on adjacent space, because you may want to be closer to the anchor, closer to the front door of the mall, say, for example. So you'd say, well, if that tenant is closer to where I want to be, I want to move over. If those tenants leave, I want the right of first refusal to go there. Okay, so the tenant relocation option. Again, relocate within the building. There's also aspects of determining the lease based off the total available square feet in the building. So, for example, if you had a single tenant in a building that has 250 square feet of gross building area, and 200 square feet of that can be rented and used, and we'd say that the base rent is, say it's $20 per square foot. So the rent would be $20 per square foot times the 200 that you could rent out, or bringing in $4 million a year. Okay. The key thing here, though, is that might be the assumption with a single tenant. Okay, so what happens if, though, we have multiple tenants? Well, with multiple tenants, so we might look on and even say one floor. Okay, so before we just say, well, we're going to rent that whole floor to the person, and they would have had the hallways, the bathrooms, everything. But if we now take that floor and we divide it up, okay, so there may be 20,000 square feet that are rentable on that floor, but once we divide it up and say, well, you can only use this area, so now we end up having common area, because everyone needs to get off the elevator and walk to their specific areas. There are office doors and so forth. So now that area is considered common area. So if we did that on every floor, rather than renting it to one large tenant, we'd be losing the rentable square feet. So instead, what you could do that, just increase the market rate. But again, a tenant might say, well, how come you're charging $22 a square foot when everybody else is charging $20 a square foot? So one of the other things you could do is say, well, we'll keep it $20 a square foot, but you'll use a load factor to load in the common areas. So, for example, at the whole floor, it's 20,000 square feet, but once you divide it into 4 tenants, only 18 of it is actually usable space. So you take the rentable divided by the usable, in this case the 20,000 divided by 18, and you have a load factor that should be 1.11, so about 11% more. And then you say, okay, the tenant's going to take 1/4 of that 18,000 square feet, but we're going to multiply it times the load factor of 1.11, and so that brings them to actually 5,000 square feet, then times the market rate of $20 per square foot, and so you get your $100,000 for that particular tenant, and you've had 4 of them, you get $400, $400,000 for the space, which is the same as the market rent times the 20,000 rentable square feet. So one thing that when you're looking around, and as you're a business owner, you're looking to lease office space, retail space, and so forth, you have to ask what's the rentable square feet, the usable square feet, are there any load factors? So you need to be able to understand what exactly is involved. Because if you say just $20 a square foot and you don't take into account the load factor, then you'd really be coming up with the wrong number. So if you take really the $20 per square foot times 1.11, in effect, the market rate is $22. Okay, $20.20. So you need to understand that aspect, so you don't think you're just paying $20 a square foot if there's a loading factor included. So you could also try to include other common areas besides the one specific floor. So you may have an entire first floor that's just all lobby area that's open to everyone as they came in. You could include this as a rent factor. So you could have the total rental square feet. So, for example, it could be 200,000 in the entire building, and the lobby itself, the lobby in the common area that you come into, is 20,000 square feet. So say, again, the 200 divided by the 20, that's 10%. So you could use that as also as a load factor. So you've got the usable area on the floor you're renting, 18,000 square feet. You're renting 1/4 of it. That's why they have the 18,000 divided by 4 for the tenant. Then they're getting charged with a load factor of 1.11 for the common area on their particular floor, and then a load for the main lobby and common area, 1.1 times the market rate of $20, and that we see works out to not 100,000 but 110,000. Okay, so in that aspect, they're really paying about $24.42 per square foot. Okay, so again, important that you understand how the rentable area is determined, including the load factors. Okay, as I've been mentioning throughout, as the lease shifts more risk to the tenant, that tenant should have a lower expected cost over the term of the lease. Okay, and we'll see that there's many variations on leases, and it could be even the variation within a building, because the leasee and the leaser have different circumstances. So one leasee may be able to take on more risk, so they're able to take on a lease that has expense steps and increases in the rent by CPI, where another tenant is not able to take that risk on. So they just want a lease that's a net lease that they know exactly what they're paying. It has steps built in, no CPI, and they know exactly what it's going to be. Okay, so same as you might have as an individual. Okay, some individuals are more risk adverse. They just want a fixed 30-year mortgage. Others more risk averse also maybe want to qualify for a higher mortgage, ready to take more risk, and they may take an option arm mortgage. Okay, so again, so there may be, even within one building, many different types of leases. And these lease terms also, besides changing with the tenant, they're also going to change with economic conditions. Same as, again, we've been talking about with the residential mortgage market. Weak rental market, you'd have many concessions. Okay, we have a weak real estate market, and we've been talking about people giving away big screen TVs and cars and lowering their prices, and therefore many other aspects. Builders giving buy downs and so forth, versus a strong rental market where they can say here you'd have CPI adjustments, versus, as we've been talking about, the strong retail market where people don't even have to fix up their houses and they can increase their prices. And so we had a few years ago where houses were being sold basically within hours of being put on the market before even all the other brokers got to see them. So very different market prices that you're getting in that aspect in the residential real estate market. First off, market conditions, the same thing happens with the rental market. If it's weak, you'll get a lot of concessions, you'll get a lot of tenant improvements, you'll get free rent built in, below market rates built in, and so forth, versus a strong market, rental market, where you won't get any tenant concessions, you won't get any tenant improvements, you won't get any free rent. You have to get the property you want, you might have to pay above market rent conditions and so forth, and you might have to put in CPI plus 1% or something like that. So it depends, again, on the strength of the market. Particularly looking at some other aspects, other property types. Hotels, obviously, generally on a daily rate. You pay so much per night. It might be different on the weekend and the weekdays. It may be that you could possibly get a weekly rate or something like that. Housing and apartments are generally annually, but it could go month to month. Offices generally go 3 to 5 years. Retail, it'll vary, but usually 1 to 2 years. Larger anchor tenants would be longer. And industrial properties, very individualized. Okay, so maybe a very long term or a shorter term. Tends to be longer term the more that it gets specific to the tenant. So in other words, if you have to put in a lot of machinery and just build the warehouse so it's more specific to your needs, they'll try to get, obviously, because of those changes in the money put in, a longer lease. Okay, this is very important. How do we come up with the effective rate? So we want to compare leases, but we cannot compare them without considering the differences in risk. So the method we're going to take is calculate the present value of the expected net rental stream. So we've got to look at the lease terms, come up with what would be the rental stream that the owner would expect, discount that back, those rents. So if it's a 5-year lease, figure out what the net rental stream is, discount it back at the appropriate discount rate that takes into account the risk. And once we get that amount, okay, so it may change over the year. It might be the same, but what if it changes? It increases by CPI and expense changes because of the stops and so forth. We'll get some dollar amount that's the present value, and then we need to solve for, because we're trying to be able to compare again, we need to solve for the equivalent level annuity. Say, what would be, here's the present value, well, what would be the amount equal if they paid the same amount every year? And again, including that aspect of risk, so the discount rate, the appropriate discount rate that should be included. And then once we've done that for a bunch of different types of risk, and we find what the equivalent level annuity would be, or the effective rent for these different lease alternatives, then we can compare which one is the cheapest. So what you want to do to understand this aspect is really study the, on page 249, but they start explaining it on the previous page and continue on the page after, Exhibit 8.3, okay, and 8.4. And this describes different leases. So the write-up is in the previous page and it follows onto the page after. But it describes leases with gross lease with stops and so forth. Net leases, gross lease without any stops or any CPI. And I've ranked them here for you on this slide from the least risky to the most risky. Okay, so the least risky would be described as a gross lease with stops and CPI increases. Okay, so as far as the base rent, okay, saying it's going to increase with CPI. So it's not as the next one down, when it doesn't have CPI, where it's not built in steps, where you just say, oh, it's going to increase $1 per square foot. Well, you don't know. Is that going to be what inflation is or not? So you're allowed to bring in CPI, so it's allowed to move with the market. And the stops, well, the benefit here is that the owner has said, well, if expenses go down, the owners kept that aspect of it because they get to participate if expenses go down. But if expenses go up, if it's just a stop, then all the risk of the expenses going up is pushed on to the leasee, okay, the person leasing, the tenant. The next would be the gross lease with just stops, because here all the increase in expense risk is pushed onto the tenant, but you have kept the fact that if it goes down, that you would benefit from this. So you've given away the expense risk, but you've kept the benefit of if the expenses go down, but you don't have the CPI built in, so it's not quite as good as the one that would have stops and the CPI. A net lease, okay, so now the operating expenses are just paid by the tenant, so the tenant has to take the upside risk if the expenses go up, but they also benefit expenses go down. So the owner has given that away, but they do get the CPI built in. The next would be the lease expense with the net lease with steps. So they'd pay it over some steps that are put in. Then you have a net lease with steps and free rent. Okay, so some concessions built in. A gross lease. Okay, so that the owner's paying all the expenses, but there's some CPI. And then finally, the most risky to the owner is just a straight gross lease. No stops, no increases in rent built in. So they just lock in a certain rate, and then everything else is really all the other risk. The risk that market rent goes up, all back on the owner, because nothing's built in to increase. The risk that the operating expenses increase, all taken by the owner, because nothing is given out, in this case, to the tenant. Okay, so as we see here, they've calculated on each of these pages what the effective rent is for these, and you'll see the one that has the lowest effective rent, if you look down, is number 6, which is the gross lease with the expense stop and the CPI index, which is what I have put there as the least risky to the owner. So the least risky to the owner also has the lowest effective rent. And the one that I've said was the most risky to the owner, the gross lease, if you look at that effective rent, $12.59, that's the highest effective rent of these. So we see that it follows through here, that the one where the owner keeps the highest risk, they get the highest effective rent. The one where the owner gives away the most risk, the lowest effective rent. I wanted to run through a couple of these, so I chose the one that was most complicated, the gross lease with the expense stop at $4 and the CPI adjustment, just to run through how they got these calculations. The only two problems I'm asking you to do in this chapter are problem 1, which follows just along what I'm doing right here, and problem 2, that follows the example I did earlier on with the loading. Okay, so if you follow that example, you should be fine on problem 2, and you follow along with this example and the write-up in the book that follows this example, you should be fine with doing problem 1. So here, the aspects, as they said, this is the lease with the CPI adjustment, 100% pass-through. Okay, so you start off with a gross rent of $450, and it increases 2% the first year for CPI, then 3% second, and so forth. If it was only 50% pass through the CPI. Well, if CPI expected to increase 2%, then the lease would only increase half of that, or 1%, and so forth. Then we have an expense stop at $4. So we have the actual, we expect expenses to be, they're currently 4, then we expect it to increase, as it in the write-up, 50 cents every year after that. But we'd say, well, what would be the reimbursement that you'd get? Well, it's a $4 stop, so the first year the expenses are $4, so nothing. But the next year you would get 50 cents because the expenses are $4.50, and you only pay the first $4. The next year $1 because the expenses are $5, you only pay the first $4, and so forth. So the net rent in this case would be, for the first year, $4.50 minus the $4 that you pay. The next year, $14.79, so minus the $4.50 in expenses, but plus the 50-cent reimbursement that you get because of the step. So the net rent would be $10.79, and so forth. That continues through. Then to find the present value of these, we'd say that the cash flow at time 1 is $10.50. All of these frequencies are 1. Time 2 is the $10.49, and so forth. And then we've been given that the required return is 10%. We just compute the net present value, and we see that the present value is $42.84. Okay, so then to get the effective yield, we say, well, what's the annuity, the equal payment? Because we see these payments change over time. Right? 10.50, 10.79. Okay, so they're increasing. But what would be the equal annuity? That's the effective rate. So we see the present value we set there as the $42.84. We'd say it's a 5-year lease, so N is 5. Again, we've decided that the discount rate should be 10%, so the interest rate's 10. No future value, nothing, no lump sum at the end here. And we just compute the payment. And we see it's $11.30. So if we did $11.30 every single year, keeping it equal, then we would have, again, and still discount that $11.30 back at the 10%, we'd get a present value of the same amount, $42.84. So that's the effective rent. Okay? And we can do that in each circumstance as they've done in this page. And in this case, we find out of the 6 leases that are discussed, this one is the lowest effective rent. And as I wrote around the bottom there, that's because it's the least risky to the owner. Because if expenses go down, then the owner benefits. So they retained that, but if expenses go up, they're protected. They've given that risk to the tenant. And they've also given the risk of increases in rent to the tenant by saying they have to pay the market base rent, plus they get 100% pass-through of any increases in inflation or CPI. Okay, so study these, how the leases work, the terms of the lease, so you come up with the net rent, number 1. So how does the CPI, how do the steps work? How do the stops work, pass-throughs, and so forth to come up with the net rent? And then once you get the net rent, how can you come up with the effective rent? Okay, so that's usually the aspect of the problem that you have on a test that has to do with this subject. And it is your main problem that you'll have to do for homework on this subject. And it will help you with developing the cash flows for valuation in the future chapters. Just quickly reviewing the lease with expense stop at 4%, but no increases in inflation. So here, the rent's just $15.50. Doesn't go up with inflation. Doesn't go up with steps. So we could have it just built up with a step of going up, say 50 cents a year, and it'd be 15, and the gross rent would be $15.50, $16, $16.50, and so forth. Here, though, no increases in rent. Everything else would then work the same, though, as the other, in that we have $4 expenses with the stop. We expect expenses to go up 50 cents a year. So you see the reimbursements from the stop, and then you get the net average rent, okay, which again works out in this case to be $11.50 every year, because the rent doesn't increase. It's always $15.50, and you always only pay $4 of expenses. Everything else is passed on, and in this case, we assume expenses just keep going up; they don't go down. So $11.50 is the net rent. It's the average rent, okay. And when you go through the present value and effective rate calculations, it also comes out to be the effective rent, okay. So concentrate on those 6 leases that are shown in Exhibit 9.8. And I think I did earlier in the slide say it was Exhibit 8.3. This used to be Chapter 8. It's now Chapter 9. So concentrate on that in Problem 1. And that will help us with the future chapters because we'll understand the different aspects of the lease and how to value them.